So how should we expect markets to react to the Fed's dovish stance? I spoke with the Refinitiv economist Oliver Dancel-Fiszer about how to view risk assets in a loose monetary and fiscal regime. The Fed is applying an aggressively dovish stance to its monetary policy, and that's got implications for inflation, economic growth and yields.
Personally, I reckon that inflation will be a lot higher than the 2% target that the Fed have. My guess is potentially even 5% over the next 12 to 18 months. And why should it not be? I mean, you've got a lot of forecasters forecasting economic growth to 7% over the same time period. You've got a rebound in commodity prices. You've got a vaccination program doing really well. And on top of all of that, you've got the stimulus program, which is putting lots of money into people's pockets as we speak. So I wouldn't really be surprised if 4 to 5% is actually, even a conservative estimate as that guess. That said, I think the amount of cash that people are sitting on and whether or not they actually spend it will depend largely on whether or not they think it's income or whether or not they believe it's wealth. In a way, it's probably not such a bad thing that the Fed are allowing the economy to run hot. We know that the Fed are concerned about the massive level of jobs lost over the pandemic. So in a way, they're kind of right to let to try and claw back a lot of those jobs. Unfortunately, what that means for bonds is, inflation expectations will probably have to rise, and that unfortunately will have to feed into higher bond yields. And I don't really think that's a bad thing because historically, 10-year treasuries have been really, really low. So over the short term, you might get a bit of fluctuations in the market, but over the longer term, I don't really see there being a massive issue in what the Fed are doing.
In a world in which the Fed lets the economy run hot, we may need to reevaluate what we consider to be risky assets.
I guess at the start of the pandemic 12 months ago, cryptocurrency, the size of the market in terms of market cap, I'm talking about Bitcoin and altcoins, the entire market, was sitting at 150 billion. Fast forward 12 months later, it's now 1.8 trillion. And what is that? That's a 1,200% increase over that same time period. So if you bought cryptocurrency, the riskiest asset of them all, you would have done really, really well. So I guess turning to now, equities, I guess if you look at the benchmark, the S&P, even a 70% increase over that same time period, you would have done really well. And why is that? Because S&P probably had one of its best years in history, likely, and a lot more than what you would get for, say, cash and bonds. I think that really hammers home the point about a risk asset. I would probably say that you might want to flip it on its head. Cash and bonds are potentially right now the risk asset. Lots of people think cash is trash, and that's not, it's not an overstatement because you can't have an economy where you're effectively debasing printing money, all the time. So your money is losing purchasing power day by day, week by week, month by month, so on and so forth. And same with bonds. I mean, will a 2% 10-year treasury really cut it for you? I'm not really sure a lot of people and a lot of investors want to be holding the bag after 10 years, given there's a massive opportunity cost of holding bonds and what you could be doing with that. Crypto, and I guess equities very much demonstrates why that is.
The pandemic has also seen a new generation of market participants embrace new styles of investing that can often seem alien to traditional investors.
So I think going into the pandemic, most people would agree there was a general trend towards passive investing, both young and old. You got the rise of BlackRock, you got Vanguard, all of those ETFs. People didn't really have too much time on their hands, and of course, that was the trend. But because of the pandemic, people had a lot more time on their hands, and it really would be surprised if actually the pendulum had now swung completely back the other way towards active investing. That's only been exacerbated by things like, very zero commission, easy entry, relatively low risk trading apps like Robinhood, Free Trade ISA here in the UK, all of which means that, investors young and old would be wanting to do their own research and really take a stab at active investing. That said, I would probably say that younger people are more likely to want to invest based on recommendations on social media. But to be honest, Roger, the one thing I'm really interested in are the sudden emergence of all of these alternative asset classes. In the last 12 months, for example, you've had a massive explosion of things like decentralized finance, non-fungible tokens. We've seen recently in the news where, an artist sold a non-fungible token for 69 million. And that's really, really great. I think that's really interesting. I think that really bodes well for potentially a whole host and different array of investing styles for generations to come for both young and old. And I think the pandemic has only really exacerbated that. Pandora's box, in a way, has really lifted the lift of all of this.
In many ways, this trend has parallels with the dot-com era, where several investments lost money as the equity market unwound. There are signs, however, that current trends may be sustainable.
If you were to compare the entire crypto market to, say, gold, the crypto market is still only just under 2 trillion. Gold is 10 trillion. Equity is globally 90 trillion. Global, real estate is 300 trillion. And then God knows what options and derivatives are, probably close to a quadrillion. So I'd probably say there's still quite a lot more room for those classes to end up, growing. I think the general narrative is, if you're looking for a safe haven asset, then Bitcoin's probably only going to go up because, you can't really tamper with it in the same way as governments can just print money and debase their economy. So I don't really believe it's just transient in that respect. I think it's very much here to stay. I think if you're an investor, if you can withstand short-term volatility and come in there with really strong hands, then generally speaking, over the long term, you'll always do very well.
The combination of the pandemic with the fiscal and monetary policy response has upended many traditional notions of investment. Some of these trends will fall away, as they do in any cycle. However, the participation of a new wave of investors who are willing to embrace new technologies and new products is set to become a permanent feature of the investment landscape.